For most participants, liquidity feels abstract. It is discussed constantly, yet rarely understood. Markets are often described as liquid or illiquid, stable or unstable, calm or volatile. But liquidity is not a mood. It is not a sentiment indicator, and it is not the same as volume. Liquidity is structural. It determines whether prices can exist without stress, whether positions can be adjusted without disruption, whether markets can absorb imbalance without repricing. Most of the time, liquidity is assumed. Trades execute, spreads remain tight, prices move smoothly. This creates the belief that liquidity is permanent. But liquidity is not permanent. It is conditional, and those conditions are changing. Liquidity exists only when participants are willing to provide it, when risk is perceived as manageable, when funding is available, when volatility is predictable. Remove any one of these, and liquidity begins to thin. Not visibly at first, but structurally. This is where misinterpretation begins. Markets often equate activity with liquidity. They see high turnover, frequent trades, rising prices, and they assume depth. But depth is not activity. Depth is the ability to transact without forcing repricing. A market can be active and illiquid at the same time. In late cycle environments, this distinction becomes critical because liquidity does not disappear evenly. It retreats selectively, it concentrates, and then it vanishes when it is needed most. To understand why liquidity failures are so destabilizing, it is necessary to understand what liquidity actually represents. Liquidity is willingness to take the other side of a trade, willingness to absorb risk temporarily, willingness to hold inventory when others want out. This willingness is not unconditional. It depends on compensation, it depends on risk limits, it depends on confidence in the system. During stable periods, willingness is abundant. Risk appears contained. Volatility is low. Funding is cheap. Liquidity providers feel protected. But protection is often an illusion because it is based on assumptions. Assumptions that volatility will remain low, that correlations will hold, that funding will remain available. These assumptions are reinforced by experience. When markets recover from every disturbance, participants learn to trust continuity. Liquidity becomes reflexive, but reflexive liquidity is fragile because it is not supported by capacity. It is supported by belief. This is why liquidity failures feel sudden, not because conditions change abruptly, but because willingness evaporates faster than price can adjust. Late cycle markets are especially vulnerable to this dynamic because they are built on optimization. Capital is allocated to maximize efficiency. Inventory is minimized. Risk is hedged continuously. Exposure is managed dynamically. This makes markets efficient. It also makes them thin. There is very little slack. In earlier market structures, liquidity providers held inventory. They absorbed imbalances. They stabilized price discovery. Today, most liquidity is provided by entities that do not want exposure. They want neutrality. Market makers hedge immediately. Algorithms adjust continuously. Systematic strategies rebalance mechanically. This works exceptionally well when conditions are stable, but it fails when conditions shift because neutrality disappears under stress. When volatility rises, hedging costs increase. When hedging costs increase, liquidity provision declines. This is not a judgment call. It is arithmetic. As risk increases, compensation required to provide liquidity increases. If compensation does not adjust quickly enough, liquidity withdraws. This withdrawal is not dramatic. It is quiet. Quotes widen. Size reduces. Execution slows. Depth disappears before price reacts. By the time price dislocations are visible, liquidity has already failed. This is why market stress often appears non-linear. Small triggers lead to large moves, not because the trigger was large, but because the system was thin. Another reason liquidity failures are misunderstood is that they are often invisible until too late. Liquidity is not measured directly. It is inferred from spreads, from execution quality, from price impact. These indicators look normal until they do not. And when they change, adjustment is rapid. Late cycle environments amplify this risk because liquidity becomes more centralized. Fewer participants provide more of it. Strategies converge, flows align. Risk is warehoused in similar ways. This concentration increases efficiency during calm periods. It reduces resilience during stress. When one major liquidity provider steps back, there is no redundancy, no buffer, no replacement. This is when repricing accelerates. The problem is not that liquidity disappears. The problem is that markets are priced as if it cannot. This is a critical distinction. Markets do not need perfect liquidity. They need sufficient liquidity relative to positioning. Late cycle markets often have extreme positioning. Leverage is embedded, exposure is extended, risk is assumed manageable. This creates mismatch. Liquidity capacity is finite. Positioning demand is large. When this imbalance becomes apparent, repricing is inevitable. Another structural issue is that liquidity is now closely tied to volatility. Low volatility encourages liquidity provision. High volatility discourages it. This creates a feedback loop. Low volatility attracts leverage. Leverage suppresses volatility. Suppressed volatility encourages more leverage until volatility rises. When it does, the loop reverses. Leverage unwinds, liquidity withdraws. Volatility increases further. This is not emotional behavior. It is mechanical. Risk models adjust. Margins increase. Funding becomes selective. Liquidity does not fail because participants panic. It fails because constraints tighten. This distinction matters because it means liquidity failures are not random. They are predictable in structure, not in timing, but in mechanism. Another factor contributing to liquidity fragility is funding dependence. Much of modern market liquidity depends on short-term funding. Positions are financed, not owned outright. As long as funding markets function smoothly, this is invisible. When funding conditions tighten, liquidity suffers immediately. Funding stress does not need to be severe. Small changes in rates, slight increases in haircuts, minor counterparty concerns. These are enough to reduce willingness. Liquidity providers become defensive. They reduce exposure, they limit size, they prioritize survival. This behavior is rational, but it leaves markets vulnerable. Late cycle markets often underestimate funding risk. They assume rollover will remain available. They price assets accordingly. When rollover becomes uncertain, repricing is swift. Another reason liquidity failures cascade is correlation behavior. During stable periods, assets appear diversified. When liquidity contracts, correlations rise. This is not because fundamentals converge. It is because selling is driven by constraint. Participants sell what they can, not what they want. Liquidity determines the sequence. This creates cross-asset stress. Markets priced for stability assume diversification will protect portfolios, but diversification depends on liquidity. Without liquidity, correlations spike. This is why liquidity failures propagate quickly. They do not remain localized. They spread. Late cycle markets are particularly exposed to this because diversification has been optimized. Risk parity, factor exposure, systematic allocation. These strategies rely on stable correlations. When correlations shift, they rebalance simultaneously. This creates synchronized flows. Synchronized flows overwhelm liquidity. This is another reason repricing accelerates. Liquidity failures are also amplified by passive flows. Passive investing does not provide discretionary liquidity. It follows price. When prices rise, capital enters. When prices fall, capital exits. This behavior smooths markets during calm periods. It amplifies moves during stress. Passive flows do not stabilize markets. They reinforce trends. In liquidity stress environments, this reinforcement accelerates repricing. Late cycle markets often ignore this dynamic because passive flows appear benign during stability. They are not benign during transition. Another overlooked factor is regulatory behavior. Regulations require institutions to reduce risk when volatility increases. Capital requirements rise. Risk limits tighten. Exposure must be reduced. This is prudent at the institutional level. It is destabilizing at the system level. When many institutions respond simultaneously, liquidity evaporates. This response is not discretionary, it is mandated. Late cycle markets often assume institutions will act as stabilizers. In reality, they act as protectors of their own balance sheets. Systemic stability becomes secondary. Another contributor to liquidity fragility is the speed of markets. Modern markets operate faster than human decision-making. Liquidity provision is automated. Risk adjustment is instantaneous. This speed increases efficiency. It reduces deliberation. When conditions change, liquidity can disappear in milliseconds. There is no gradual transition. This makes repricing appear sudden. But the underlying vulnerability was building over time. Another critical element is expectation anchoring. Participants anchor to recent liquidity conditions. They assume what worked yesterday will work tomorrow. This assumption affects positioning. Risk is increased. Hedges are reduced. Exposure is extended. Late cycle markets reward this behavior until liquidity conditions change. When they do, anchoring becomes a liability. Participants are unprepared. Adjustment is forced. This is why liquidity failures feel like shocks, not because they are unpredictable, but because expectations were narrow. Liquidity is not an on-off switch. It degrades, but degradation is difficult to observe in real time. By the time it becomes visible, repricing is already underway. This is the core danger. Markets price liquidity as if it will always be sufficient. They price assets accordingly. When liquidity fails to meet positioning demand, prices must adjust. This adjustment is not optional. It is structural. Late cycle environments maximize this risk. Because positioning is heavy, leverage is embedded, confidence is high. All of this depends on liquidity remaining abundant. When that assumption fails, repricing is swift, not chaotic, not emotional, mechanical. This is why liquidity is the most important variable in market stability, not growth, not earnings, not narratives. Liquidity determines whether prices can exist at current levels. When liquidity fails, everything reprices, not because value changed, but because capacity did. This is the transition phase, not a collapse, but a recalibration. Markets adjusting to new constraints, constraints that were always there, but ignored because liquidity masked them. This is why late cycle markets feel deceptively calm. Liquidity suppresses visible stress. It allows imbalances to grow. When liquidity retreats, those imbalances surface, not gradually, but structurally. This is the environment markets are entering, not a crisis by default, but a regime where liquidity is selective, where repricing is faster, where stability is conditional. Understanding this changes how risk should be viewed. Risk is not volatility. Risk is dependence on liquidity. Late cycle markets are deeply dependent. That dependence is the vulnerability, and it is not priced. Not yet. For decades, policy responses were designed to stabilize liquidity. When markets tightened, central banks eased. When volatility rose, funding conditions were relaxed. When stress emerged, balance sheets expanded. This framework worked because the structure supported it. Inflation was low. Debt levels were manageable. Market participants trusted intervention. Liquidity responded positively to policy signals. But that relationship has changed. Policy tools that once restored liquidity now often weaken it. Not immediately, not visibly, but structurally. This is one of the most misunderstood shifts in modern markets. Central banks still intervene, rates still move, balance sheets still matter. But the transmission mechanism is different. Policy no longer operates in an environment of slack. It operates in an environment of constraint. This distinction changes outcomes. In earlier cycles, easing policy reduced uncertainty. Lower rates encouraged risk-taking. Liquidity providers expanded balance sheets. Funding costs declined. The system absorbed intervention smoothly. Today, easing policy can increase uncertainty. Markets question sustainability. Inflation expectations respond. Credibility is challenged. Liquidity providers hesitate. Instead of expanding capacity, they protect it. This inversion is critical because liquidity depends on confidence, not confidence in markets, confidence in structure. When policy creates ambiguity instead of clarity, liquidity suffers. One reason is inflation sensitivity. In a low inflation environment, easing is stabilizing. In a high inflation environment, easing is destabilizing. Liquidity providers must consider second-order effects. Will easing weaken the currency? Will inflation accelerate? Will funding costs rise later? These questions did not matter when inflation was dormant. They matter now. As a result, policy signals no longer produce uniform responses. Some participants increase exposure, others reduce it. This fragmentation reduces liquidity. Markets appear functional, but depth is uneven. Another reason policy responses amplify instability is balance sheet fatigue. After years of expansion, central bank balance sheets are large. Markets understand this. They know capacity is finite. They know political tolerance is limited. This changes expectations. Intervention is no longer seen as unlimited. When support is perceived as conditional, behavior changes. Liquidity providers demand higher compensation. They reduce duration. They limit exposure. This makes markets more sensitive to shocks. Policy action becomes less effective. Another structural shift is the interaction between policy and leverage. Prolonged easing encouraged leverage. Leverage became embedded. Strategies were built around it. Returns depended on it. When policy tightens, leverage becomes unstable. But when policy eases in an inflationary environment, leverage does not automatically return. Participants question durability. They ask whether easing will be reversed, whether inflation will respond, whether funding conditions will remain favorable. This uncertainty suppresses willingness. Liquidity providers do not commit fully. They stay flexible. Flexibility reduces depth. Another issue is signaling asymmetry. Policy tightening is now seen as credible. Policy easing is seen as constrained. This asymmetry affects expectations. Markets believe central banks will tighten to fight inflation. They doubt central banks can ease aggressively without consequence. This belief alters behavior. Liquidity providers respond more strongly to tightening than easing. This makes liquidity pro-cyclical. Tightening removes liquidity quickly. Easing restores it slowly, if at all. This asymmetry increases volatility. Another reason policy responses amplify instability is the role of forward guidance. Forward guidance once reduced uncertainty. Markets trusted projections. Expectations were anchored. Today, guidance is frequently revised. Inflation surprised policymakers. Rate paths changed abruptly. Confidence weakened. Liquidity providers discount guidance. They focus on realized conditions. This reduces the stabilizing effect of communication. Policy becomes reactive rather than directive. Markets move first. Policy follows. This reverses the traditional dynamic. Another structural change is fiscal dominance risk. High government debt constrains policy. Markets understand this. They know aggressive tightening threatens fiscal stability. They know aggressive easing threatens inflation control. This creates ambiguity. Policy actions are interpreted through a political lens. Liquidity providers price this uncertainty. They reduce exposure. They shorten time horizons. They avoid commitment. This weakens liquidity. Another factor is the global nature of liquidity. Policy decisions in one region affect others. When major central banks tighten, global funding tightens. When they ease, currency dynamics shift. Emerging markets respond. Capital flows adjust. These spillovers complicate liquidity provision. Participants must manage cross-border risk. This reduces willingness to provide liquidity domestically. Another overlooked aspect is the interaction between policy and regulation. Regulatory frameworks were designed for stability. Capital buffers, liquidity requirements, stress tests. These improve institutional resilience. They also make institutions more pro-cyclical. When policy tightens, regulations force risk reduction. When volatility rises, capital requirements increase. Institutions reduce exposure simultaneously. Policy easing does not reverse these requirements immediately. Liquidity remains constrained. This delays stabilization. Another reason policy responses now amplify instability is expectation mismatch. Markets were conditioned to expect immediate relief. When relief is delayed or limited, disappointment creates volatility. Participants reposition aggressively. Liquidity thins. This reaction is not emotional. It is structural. Expectations were misaligned with capacity. Another factor is the speed of modern markets. Policy operates slowly. Markets operate instantly. When policy signals uncertainty, markets adjust immediately. Liquidity withdraws before policy effects materialize. This front-runs stabilization. Another issue is that policy tools have diminishing returns. Each intervention adds less liquidity than the previous one. Markets recognize this. They discount effectiveness. Liquidity providers respond cautiously. This caution becomes self-reinforcing. Less liquidity increases volatility. Higher volatility reduces liquidity provision further. This is the opposite of the intended effect. Another structural shift is the perception of downside risk. In earlier cycles, policy reduced downside. Today, policy can increase it. Inflation risk, currency risk, political risk. Liquidity providers must account for these. This changes pricing, spreads widen, depth reduces, execution worsens, markets still function, but they are fragile. Another reason policy responses amplify instability is that they reveal constraints. Every intervention exposes limits. Markets learn, they adjust expectations. Liquidity becomes conditional. This is not failure, it is adaptation. But adaptation reduces the illusion of stability. Late cycle markets are sensitive to this because they are priced for certainty. When policy introduces uncertainty, repricing follows. Another important factor is that policy responses now often target symptoms rather than structure. They address price movements. They address volatility spikes. They do not address leverage. They do not address concentration. They do not address funding dependence. Liquidity issues persist. Markets stabilize temporarily. Vulnerability remains. This creates recurring stress. Another structural issue is the credibility gap. Markets remember past misjudgments. Inflation was underestimated. Policy paths were miscommunicated. Liquidity providers incorporate this history. They trust less. They demand more compensation. Liquidity thins. Another reason policy responses can worsen instability is timing. Policy acts with lags. Markets move ahead. By the time policy effects arrive, conditions have changed. Liquidity providers are already defensive. Stabilization is delayed. Another factor is heterogeneity of response. Not all participants respond the same way. Some increase risk, others reduce it. This divergence fragments liquidity. Markets appear liquid in parts, illiquid in others. This fragmentation increases volatility. Another overlooked issue is that policy easing can increase correlation risk. By compressing spreads and yields, policy encourages crowded positioning. When those positions unwind, liquidity evaporates. This is why interventions sometimes set the stage for future instability. They stabilize now. They fragilize later. Late cycle markets are living with this legacy. Years of intervention compressed risk, concentrated exposure, reduced redundancy. Policy responses today must operate within this structure. They cannot reverse it quickly. This is why outcomes differ. Liquidity no longer responds linearly to policy. It responds conditionally, and those conditions are increasingly restrictive. This does not mean policy is irrelevant. It means its role has changed. Policy no longer guarantees stability. It influences the path of adjustment. Adjustment is unavoidable. Liquidity determines how that adjustment occurs. When policy actions fail to restore confidence, liquidity remains selective. Markets adjust through repricing, not panic, repricing. This is the new regime. Liquidity never disappears everywhere at once. It breaks at the margins first. This is one of the most consistent patterns across market cycles. When instability begins, it does not appear where attention is focused. It appears where assumptions are strongest. Markets tend to watch the obvious: equity indexes, major currencies, headline assets. But liquidity stress does not start there. It starts in places considered unimportant, peripheral, safe, routine. This is what makes it dangerous. Because by the time stress reaches visible markets, liquidity has already fractured beneath the surface. The first point of failure is almost always assumed to be stable. Short-term funding, collateral markets, low volatility instruments, carry trades, interbank flows. These areas are not watched for risk. They are watched for efficiency. That is the mistake. Liquidity breaks first where it is taken for granted, because no buffers are built where no risk is perceived. In late cycle environments, stability is priced aggressively. This compresses margins. It reduces redundancy. It removes slack. Liquidity becomes optimized. Optimized systems perform well under expected conditions. They fail abruptly under deviation. The first cracks appear where leverage is highest relative to perceived risk. Short duration assets, low volatility strategies, instruments designed to earn small, consistent returns. These positions rely on continuous liquidity. They assume rollover. They assume tight spreads. They assume smooth functioning. When conditions shift, these assumptions fail immediately. This is why the first break is rarely dramatic. It looks like noise, a minor funding issue, a temporary spread widening, an isolated stress. But these events are signals. They indicate that liquidity is becoming selective. Selective liquidity is the beginning of instability, because selective liquidity means not everyone can transact at the same time. In healthy systems, liquidity is broadly available. In fragile systems, Liquidity becomes conditional. This transition is subtle. Volumes may remain high. Prices may not move much. Markets appear calm, but depth is thinning. The system is losing its ability to absorb shocks. Another reason liquidity breaks first in unexpected places is structural invisibility. Many liquidity channels operate out of public view: repo markets, derivatives margining, collateral rehypothecation, internal funding arrangements. Stress in these areas does not show up immediately in prices. It shows up in behavior. Participants shorten duration, they reduce position size, they increase haircuts, they tighten terms. These actions are defensive. They do not make headlines. They quietly change structure. By the time price reacts, structure has already shifted. This is why late cycle breakdowns feel sudden. They are not sudden. They are revealed. Another reason the first break is missed is narrative bias. Markets anchor to dominant stories, growth narratives, policy narratives, stability narratives. When reality contradicts these narratives, the contradiction is dismissed. Early signs of liquidity stress do not fit the story, so they are ignored. Participants assume anomalies will resolve. They usually do, until they do not. Late cycle environments are defined by this complacency. Because recent history reinforces it, every prior stress was contained, every disruption was temporary. This conditions behavior. Risk management becomes reactive, not proactive. By the time action is taken, liquidity has already fractured. Another reason liquidity breaks first in specific areas is regulatory structure. Regulations concentrate liquidity risk, capital requirements, liquidity coverage ratios, stress scenarios. These frameworks improve institutional safety. They also synchronize behavior. When conditions deteriorate, institutions respond similarly. They reduce exposure. They preserve capital. They hoard liquidity. This simultaneous response removes liquidity from the system. Not because institutions want to destabilize markets, because they are required to protect themselves. The first places to lose liquidity are those most sensitive to regulatory thresholds. Short-term funding markets, market-making inventories, structured products. These areas adjust instantly. Prices do not need to move much. Behavior does. Another factor is the role of leverage. Leverage does not fail uniformly. It fails at the weakest link. Positions funded short-term against long-term assets. Strategies dependent on low volatility. Trades with asymmetric margin requirements. These positions face immediate pressure when volatility rises or funding tightens. They are forced to adjust. Forced adjustment is not discretionary. It is mechanical. Mechanical behavior is synchronized. This creates localized stress. That stress spreads. Another reason liquidity breaks first in safe areas is psychological. Participants feel comfortable there. They allocate more capital. They use more leverage. They monitor less closely. This creates concentration. Concentration increases fragility. When stress appears, the exit is crowded. Liquidity disappears. Another overlooked factor is the role of correlation. During calm periods, correlations appear low. Assets move independently. Diversification looks effective. But this independence depends on liquidity. When liquidity thins, correlations rise. This rise does not start in major assets. It starts where liquidity is weakest. Peripheral markets, secondary instruments, less traded maturities. As correlations increase, stress spreads. Participants are forced to sell assets unrelated to the initial problem. This is how localized liquidity stress becomes systemic. Another reason the first break is missed is because markets confuse activity with liquidity. High trading volume is mistaken for depth, but volume does not equal capacity. Liquidity is the ability to transact without repricing. In fragile systems, volume can be high even as liquidity declines. Trades occur, prices move slightly, but the cost of size increases. This is invisible to casual observation. Only participants transacting size notice. By the time price dislocations become obvious, liquidity is gone. Another factor is the role of passive strategies. Passive flows smooth price action during stable periods. They suppress volatility. They reinforce trends, but they do not provide liquidity under stress. They react after prices move. This creates a symmetry. Liquidity appears abundant on the way up, scarce on the way down. The first areas to feel this effect are those heavily represented in passive structures. Index components, factor-based strategies, volatility targeting funds. When conditions shift, these strategies reduce exposure mechanically. Liquidity is withdrawn simultaneously. Another reason liquidity breaks first in unexpected places is time, horizon mismatch. Many liquidity providers operate on short horizons. Funding is short-term. Risk limits are tight. Assets are long-term. This mismatch is manageable when conditions are stable. When conditions shift, short-term horizons dominate. Liquidity providers prioritize survival. They reduce exposure quickly. Long-term asset prices adjust slowly. This creates dislocations. The first dislocations appear where mismatch is greatest. Another structural factor is information asymmetry. Liquidity providers often see stress before others. They observe funding conditions. They see order flow. They feel balance sheet pressure. They act early. Their actions reduce liquidity. Others notice later. This creates a gap. By the time broader markets react, liquidity has already been withdrawn. Another reason the first break is subtle is that it does not involve fear. It involves caution. Participants do not panic. They become selective. Selectivity reduces liquidity. This is not emotional, it is rational, but it changes system behavior. Markets rely on indiscriminate liquidity to function smoothly. When liquidity becomes selective, volatility increases. Another factor is the role of collateral. Collateral underpins liquidity. When collateral values fluctuate, liquidity adjusts. In late cycle environments, collateral is often reused extensively. Rehypothecation increases efficiency. It reduces buffers. When collateral values decline slightly, the impact is magnified. Haircuts increase, availability decreases, liquidity contracts. This contraction starts where collateral chains are longest. Those areas are rarely visible. Another reason liquidity breaks first in specific areas is that those areas are not designed for stress. They are designed for efficiency, short-term funding, structured credit, derivatives markets. These systems assume continuous functioning. They lack redundancy. When conditions deviate, they fail quickly. Another reason the first break is missed is recency bias. Participants assume recent stability will continue. They extrapolate. They dismiss early warning signs. This is not irrational. It is human. But markets punish it. Another factor is the role of margin. Margin requirements adjust dynamically. When volatility rises, margin increases. This forces deleveraging. Deleveraging removes liquidity. The first assets to experience this are those with high leverage relative to volatility. These assets often appear safe until they are not. Another overlooked issue is that policy responses can accelerate the first break. When policy tightens, funding costs rise. When policy eases under inflation risk, uncertainty rises. Both outcomes affect liquidity. The first areas to react are those most sensitive to funding and expectations. Again, not headline assets. Peripheral channels. Another reason liquidity breaks first in non-obvious places is that those places lack advocates. No one defends them publicly. No one frames them as important. Stress there is ignored until it spreads. Another structural issue is that markets are interconnected. Liquidity stress propagates through linkages. Funding markets affect derivatives. Derivatives affect equities. Equities affect collateral. Collateral affects funding. This loop accelerates adjustment. The initial trigger does not matter. Structure does. Another factor is the erosion of shock absorbers. In earlier cycles, discretionary liquidity providers absorbed stress. Today, automation dominates. Algorithms respond instantly. Risk models adjust automatically. There is no pause. Liquidity disappears faster. Another reason the first break is subtle is that prices may not fall sharply. They may drift, they may gap slightly, they may behave oddly. These are signs, but they are often dismissed. Another overlooked aspect is that late cycle markets are optimized. Optimization removes slack. Slack is resilience. Without slack, systems fail abruptly. Liquidity breaks first, where slack was removed earliest. These areas are often seen as safest. This is the paradox. The safest looking parts of the system are often the most fragile because they were optimized hardest. Another reason liquidity breaks first in these areas is because participants do not hedge them. They hedge obvious risks. They ignore assumed stability. When stress appears, there is no protection. Adjustment is forced. Another structural factor is that markets price probability, not consequence. Low probability events are discounted. High impact outcomes are ignored. Liquidity stress is low probability during calm periods, but its impact is large. Markets misprice this trade-off. Another reason the first break is missed is because it is incremental. Liquidity does not vanish instantly. It degrades, spreads widen slightly, size reduces, terms tighten. These changes accumulate. At some point, the system crosses a threshold. Liquidity disappears. The transition appears sudden. It was not. Another reason liquidity breaks first in specific areas is that those areas rely on confidence rather than fundamentals. Funding markets depend on trust. Trust can change quickly. When trust weakens, liquidity evaporates. Another factor is that late cycle markets are conditioned to ignore small stresses. They have seen them before. They resolved. This conditions complacency until resolution fails. Another structural issue is that modern markets rely on continuous pricing. Assets are marked constantly. This increases transparency. It also increases sensitivity. Small changes force adjustment. Liquidity providers respond quickly. Another reason the first break is subtle is that it often coincides with positive narratives. Markets are optimistic. Growth appears strong. Earnings look good. Stress signals conflict with this. They are ignored. Another factor is that participants assume central banks will intervene. This assumption delays adjustment. When intervention is constrained, adjustment accelerates. Another reason liquidity breaks first in certain areas is that those areas have asymmetric payoffs, small gains, large losses. Participants accept this because losses are assumed unlikely. When losses materialize, adjustment is severe. Another overlooked issue is that liquidity stress feeds on itself. Reduced liquidity increases volatility. Higher volatility reduces liquidity further. This feedback loop accelerates breakdown. The first break triggers the loop. By the time it is visible, the loop is active. This is why markets appear calm until they are not. Liquidity does not announce its departure. It withdraws quietly. Understanding this is critical because it explains why warning signs are ignored, not because they are invisible, but because they appear unimportant until they are everything. Market breakdowns are rarely caused by a single event. Yet every major repricing is eventually explained as if it were a headline, a policy decision, a geopolitical shock, an unexpected data point. These explanations are comforting. They suggest causality, they imply predictability, they give the impression that outcomes could have been avoided, but they are almost always wrong. Triggers do not cause breakdowns, they reveal them. Markets break because structure fails, not because news arrives. News only determines timing. This distinction is essential, because focusing on triggers obscures the real mechanism. Late cycle markets often appear resilient. Prices hold. Volatility remains subdued. Confidence persists. This creates the belief that the system is strong. In reality, strength is an illusion. The system is stable only as long as assumptions hold. Liquidity remains available. Funding remains cheap. Correlations remain contained. Confidence remains intact. When one of these assumptions fails, structure adjusts. The adjustment does not require a dramatic catalyst. It requires pressure. Pressure accumulates quietly. Imbalances grow. Positioning concentrates. Leverage embeds itself. This pressure does not manifest in headlines. It manifests in fragility. Fragility is not visible until the system is tested. When the test arrives, the system reacts. That reaction is often attributed to the test itself. This is the error. The test did not cause the failure. It exposed it. This is why breakdowns often feel confusing. The reported cause seems insufficient. The reaction seems excessive. This mismatch leads to disbelief. Participants struggle to reconcile small events with large outcomes. The reconciliation lies in structure. Structure determines sensitivity. Sensitive systems react disproportionately. Late cycle markets are sensitive. They are optimized. They are leveraged. They are concentrated. Small disturbances travel far. Another reason triggers are misidentified is narrative bias. Markets prefer simple stories. They want a reason. Attributing breakdowns to single events provides closure. It avoids confronting systemic vulnerability. But systemic vulnerability is the real cause. It builds slowly. It remains invisible. It is ignored until it is undeniable. Another reason triggers are misinterpreted is timing coincidence. Structural stress accumulates over long periods. Eventually something happens. Anything, a speech, a report, a surprise. That event coincides with the release of pressure. The event is blamed, but the system was already primed. Had the event not occurred, another would have. This is why different cycles blame different triggers. The structure is consistent. The stories change. Another reason breakdowns are misunderstood is that markets rarely collapse at obvious extremes. They often break during calm periods, when volatility is low, when confidence is high, when participation is broad. This contradicts intuition. People expect breakdowns during fear. They occur during certainty, because certainty compresses margins of safety. Risk is assumed manageable. Protection is reduced. Exposure increases. This creates fragility. Fragility requires very little to activate. Another factor is the lag between cause and effect. Structural imbalances take time to form. Their consequences are delayed. When consequences appear, the cause is no longer visible. Participants look for immediate explanations. They find triggers. The true cause is already in the past. Another reason triggers dominate narratives is that structure is complex. Liquidity, leverage, funding, correlation. These are difficult to explain. Triggers are simple. They fit headlines. They fit conversations. But simplicity is misleading. Markets are complex systems. Complex systems fail due to interaction, not isolated inputs. Another reason triggers are misattributed is that participants underestimate feedback loops. When selling begins, it creates conditions for more selling. Prices fall, margins increase, liquidity withdraws. These effects reinforce one another. The initial trigger is irrelevant once the loop starts. The loop drives outcomes. Late cycle markets are particularly vulnerable to feedback loops because leverage is embedded, because liquidity is thin, because behavior is synchronized. Once feedback begins, it accelerates. Another reason triggers are blamed is psychological comfort. If breakdowns are caused by events, they feel controllable. If they are caused by structure, they feel inevitable. People prefer controllable explanations. Markets do not. Another factor is media framing. Media focuses on events. It needs narratives. It needs immediacy. Structural explanations lack immediacy. They are gradual. They are subtle. They do not create urgency, so they are ignored. Another reason breakdowns are misunderstood is that markets often appear to recover quickly after initial stress. This reinforces the belief that the trigger was temporary. But recovery does not eliminate structural damage. Liquidity does not fully return. Confidence does not fully reset. Positioning remains altered. The system becomes more sensitive. The next adjustment requires less pressure. This is why late cycle breakdowns often occur in waves. Each wave is blamed on a different trigger. The structure deteriorates steadily. Another factor is policy intervention. Intervention often halts immediate collapse. This creates the impression that the problem is solved. In reality, intervention shifts the adjustment. It delays it. It redistributes it. Structural imbalances remain. Triggers continue to appear. Markets react repeatedly. Another reason triggers dominate explanations is that participants focus on what changes, not what remains. They notice new events. They ignore persistent conditions. But persistent conditions determine outcomes. Events merely interact with them. Another overlooked aspect is that late cycle markets are highly reflexive. Prices influence behavior. Behavior influences prices. This reflexivity amplifies movement. Triggers interact with reflexivity. They do not cause it. Another reason breakdowns appear sudden is that markets suppress volatility until thresholds are crossed. Volatility does not rise linearly. It jumps. This creates the impression of shock, but the underlying stress was building. Another reason triggers are misattributed is that markets confuse correlation with causation. An event occurs. Markets move. The event is blamed. But correlation does not imply causation. Structure determines causation. Another factor is that participants underestimate tail risk. Low probability outcomes are ignored. They are not priced. When they materialize, they dominate. Triggers are blamed because tail risk was not considered. Another reason breakdowns are misunderstood is that markets are adaptive. They evolve. Participants adjust strategies. New vulnerabilities emerge. Old frameworks fail. Triggers change. Structure rhymes. Another overlooked issue is that markets often break in areas with positive news. This creates confusion, good data, strong earnings, optimistic forecasts, yet markets fall. This contradicts narratives. The contradiction is resolved by blaming unrelated triggers. The real cause is structural misalignment. Another reason triggers are overemphasized is that markets often ignore capacity. They focus on demand. Prices rise because demand is strong, but supply of liquidity matters more. When liquidity supply fails, demand becomes irrelevant. Triggers distract from this reality. Another factor is the illusion of control. Participants believe risk can be managed precisely. Triggers challenge this belief. Blaming triggers preserves the illusion. Accepting structural fragility destroys it. Another reason breakdowns are misunderstood is that markets often move before fundamentals change. Prices adjust ahead of data. This creates confusion. Triggers are blamed because fundamentals appear intact. Structure moved first. Another overlooked aspect is that markets often discount warnings until they are validated. Warnings conflict with performance. They are costly to heed. Triggers provide validation. They justify reaction. But by the time validation arrives, adjustment is forced. Another reason triggers dominate explanations is hindsight bias. After the fact, explanations appear obvious. Before the fact, they were invisible. This reinforces confidence in narratives. It does not improve understanding. Another factor is that markets often conflate uncertainty with risk. Uncertainty increases. Risk perception changes. Triggers increase uncertainty, but risk was already present. Another reason breakdowns appear irrational is that structure operates mechanically. Mechanical systems do not respond to logic, they respond to thresholds. Triggers push systems past thresholds. They do not define them. Another overlooked issue is that late cycle markets are crowded. Crowding increases sensitivity. When exits are narrow, movement accelerates. Triggers become excuses. Another reason triggers are misidentified is that markets often break after periods of good performance. This creates disbelief. Participants expect weakness after losses, but fragility builds during gains. Triggers arrive when least expected. Another factor is that markets often ignore negative convexity. Losses accelerate faster than gains. Triggers expose this asymmetry. Another reason breakdowns are misunderstood is that participants assume stability is natural. It is not. It is constructed. When construction weakens, collapse appears sudden. Another overlooked aspect is that markets price probability, not consequence. Triggers change perceived probability. Structure determines consequence. Another reason triggers dominate narratives is that they absolve responsibility. If an event caused the breakdown, no one mispriced risk. If structure caused it, many did. Another factor is that markets are path-dependent. Past decisions shape present vulnerability. Triggers interact with this path. Another reason breakdowns are misunderstood is that markets rarely revisit the true causes. They move on. They rebuild narratives. They repeat cycles. Understanding structure is uncomfortable. It implies limits. It implies inevitability. It implies that stability is temporary. This is why triggers persist as explanations. They are simpler, but they are wrong. Markets do not break because of events. They break because structure can no longer support positioning. Events merely reveal this. Late cycle markets are primed for this revelation, not because something bad will happen, but because too much depends on assumptions. When assumptions fail, repricing follows. Quietly at first, then all at once. When liquidity fails, the first response is almost always the same. Relief, markets bounce, prices recover, volatility compresses. This response is interpreted as confirmation. Confirmation that the system worked. Confirmation that the risk was temporary. Confirmation that intervention was sufficient. But this interpretation is often incorrect. The initial rebound following a liquidity failure rarely repairs structure. It usually weakens it. This is one of the most counterintuitive aspects of late cycle behavior. Rebounds are assumed to be stabilizing. In reality, they are often destabilizing because they reinforce the assumptions that caused fragility in the first place. After a liquidity shock, market participants reassess, but reassessment is shallow. Positions are trimmed, not abandoned. Leverage is reduced marginally, not structurally. Risk models are adjusted temporarily, not redesigned. The system breathes, it does not heal. This breathing space creates a dangerous illusion, the illusion that the worst is over. Confidence returns faster than resilience. Prices recover faster than liquidity depth. Volatility falls faster than funding stability. Narratives reset faster than structure. This mismatch matters because it increases sensitivity. The system emerges from stress thinner, not stronger. Another reason rebounds are destabilizing is behavioral reinforcement. Participants who maintained exposure are rewarded. Participants who reduced risk underperform. This reinforces behavior. Risk-taking is validated. Caution is penalized. The lesson learned is not restraint, it is persistence. This lesson accelerates re-risking. Exposure returns quickly. Leverage creeps back. Hedges are removed. But the system has not reset. Liquidity providers remain cautious. Funding conditions remain tighter. Correlation remains elevated beneath the surface. The apparent calm masks reduced capacity. Another destabilizing effect of rebounds is positioning concentration. Rebounds tend to favor the same assets that dominated before. Leadership does not rotate. Crowding persists. This concentrates risk further. The system becomes more dependent on fewer supports. Another factor is policy interpretation. Rebounds are often attributed to intervention. This strengthens belief in policy backstops. Participants assume support will continue. They extrapolate intervention. But policy capacity is not infinite. Each intervention reduces future flexibility. Each use creates precedent. Each precedent increases expectation. When expectations rise faster than capacity, fragility increases. Another destabilizing aspect is volatility suppression. Rebounds compress volatility quickly. Low volatility encourages leverage. It reduces hedging costs. It incentivizes carry trades. But volatility suppression following stress is artificial. It does not reflect improved resilience. It reflects temporary relief. This creates negative convexity. The next volatility spike becomes more damaging. Another reason rebounds weaken structure is that they delay adjustment. Markets adjust through repricing. Repricing redistributes risk. Redistribution restores balance. Rebounds interrupt this process. They postpone repricing. They preserve imbalances. They defer pain. Deferred pain accumulates. Another factor is that rebounds reduce urgency. Warnings are dismissed. Signals are ignored. Preparation is delayed. Participants assume the system has absorbed stress. In reality, it has transferred it. Another destabilizing effect is margin recalibration. During stress, margins increase. After rebounds, margins ease. This encourages re-leveraging. But the underlying funding sensitivity remains. The system oscillates between tight and loose conditions. Each oscillation increases fragility. Another reason rebounds are misleading is that liquidity does not recover symmetrically. Liquidity withdraws quickly during stress. It returns slowly afterward. Market makers remain cautious. Balance sheets remain constrained. Depth remains shallow. Prices may recover, but capacity does not. This creates price illusion. Another factor is that rebounds increase reflexivity. Price recovery reinforces confidence. Confidence reinforces risk-taking. Risk-taking reinforces price recovery. This feedback loop operates until it breaks. And when it breaks, the system is more fragile than before. Another destabilizing aspect is narrative reset. Rebounds revive dominant narratives. Growth optimism, soft landing expectations, policy control beliefs, these narratives suppress risk awareness. They crowd out alternative scenarios. This narrows expectation ranges. Narrow expectations increase convexity. Another reason rebounds are dangerous is that they reduce time for adjustment. Gradual repricing allows adaptation. Sharp rebounds interrupt it. Participants postpone. decisions. When adjustment resumes, it is compressed. Another factor is that rebounds mask deterioration in liquidity quality. Liquidity becomes more selective. It favors large participants. It excludes marginal ones. This creates uneven resilience. Weak participants fail quietly. Strong ones absorb temporarily. Systemic fragility increases. Another destabilizing effect is regulatory response. Regulations often tighten after stress. Capital requirements increase. Risk limits adjust. These changes reduce flexibility. When the next shock arrives, capacity is lower. Another reason rebounds weaken structure is that they increase complacency toward funding risk. Funding markets often remain fragile after stress. Counterparty trust erodes. Haircuts remain elevated. Rollover risk increases. Prices ignore this until funding tightens again. Another factor is that rebounds do not eliminate leverage, they redistribute it. Some participants exit, others replace them. Leverage migrates to less regulated areas. Opacity increases. Systemic visibility declines. Another destabilizing aspect is that rebounds shift risk from visible to hidden forms. Derivatives replace cash positions. Options replace equities. Structured products replace bonds. Risk does not disappear. It becomes harder to track. Another reason rebounds are misleading is that they are often liquidity-driven, not conviction-driven. Flows return. Momentum reasserts. But fundamental alignment is absent. This creates hollow rallies. Hollow rallies collapse easily. Another factor is that rebounds reinforce the belief that timing matters more than structure. Participants focus on entries and exits. They ignore capacity, but structure determines outcomes, not timing. Another destabilizing effect is that rebounds reduce diversification effectiveness. Correlations remain elevated. Assets move together. Diversification appears restored. It is not. This creates false security. Another reason rebounds are dangerous is that they compress spreads artificially. Credit spreads tighten. Risk premiums fall. But underlying credit quality has not improved. This mispricing increases sensitivity. Another factor is that rebounds often occur in low-volume environments. Participation is narrow. Moves are exaggerated. This creates fragility. Another destabilizing aspect is that rebounds encourage leverage normalization. Leverage becomes baseline again. Risk models adjust to new volatility regime. This embeds fragility. Another reason rebounds mislead is that they obscure second-order damage. Some institutions weaken, some funding channels degrade, some strategies fail. These effects are not visible in price. They accumulate beneath the surface. Another factor is that rebounds delay recognition of regime change. Participants assume continuity, but regime shifts do not reverse quickly. They evolve. Rebounds create denial. Another destabilizing effect is that rebounds increase asymmetry. Upside becomes limited. Downside expands. Markets priced for stability ignore this. Another reason rebounds weaken structure is that they reduce optionality. Participants commit capital prematurely. Flexibility declines. When adjustment resumes, options are limited. Another factor is that rebounds encourage the belief that stress is contained. Containment is temporary. Structure remains compromised. Another destabilizing aspect is that rebounds increase reliance on fewer supports. Policy, liquidity, confidence. When one fails, impact is greater. Another reason rebounds are misleading is that they are interpreted as confirmation of resilience. Resilience is the ability to absorb stress without disorder. Rebounds do not measure resilience. They measure relief. Another factor is that rebounds do not restore trust fully. Counterparties remain cautious. Terms remain restrictive. The system becomes brittle. Another destabilizing effect is that rebounds encourage recrowding. Crowding reduces exit capacity. Another reason rebounds weaken structure is that they reduce the perceived cost of risk. Risk appears cheap again. This encourages accumulation. Another factor is that rebounds shift attention away from structure back to price. Price becomes the signal again. Structure is ignored. Another destabilizing aspect is that rebounds reset benchmarks. High watermarks increase. Pressure to perform intensifies. Risk-taking escalates. Another reason rebounds are dangerous is that they occur before balance sheets repair. Losses are not fully absorbed. Capital is not rebuilt. The system remains vulnerable. Another factor is that rebounds often coincide with narrative fatigue. Warnings lose impact. Participants tune out. Another destabilizing effect is that rebounds reduce learning. The system does not internalize stress. It repeats mistakes. Another reason rebounds weaken structure is that they compress time. Horizons, participants focus on short-term performance. Long-term resilience is ignored. Another factor is that rebounds increase dependency on continuation. Continuation becomes necessary. This creates fragility. Another destabilizing aspect is that rebounds mask slow-moving damage, funding frictions, legal risks, operational stress. These accumulate silently. Another reason rebounds are misleading is that they create false closure. Participants assume the episode is over. It is not. It is pause. Late cycle markets often experience multiple relief rallies, each one weaker, each one more fragile. The final adjustment is not caused by a new event. It is caused by exhaustion. Exhaustion of liquidity, exhaustion of confidence, exhaustion of capacity. Rebounds accelerate this exhaustion because they prevent reset, because they preserve imbalance, because they reward behavior that created fragility. Understanding this changes interpretation. Relief is not resolution. Recovery is not repair. Calm is not capacity. Late cycle rebounds are not signs of strength. They are signs of deferred adjustment. They are the system buying time. And time in fragile systems is not neutral. It increases sensitivity. When adjustment resumes, it is harsher, not because something new happened, but because structure had less capacity left. This is why late cycle breakdowns often feel repetitive. Stress, relief, stress again. Each iteration weaker, each recovery shorter, each adjustment sharper, until resolution occurs, not through rebound, but through repricing. The final phase of a market cycle is often misunderstood. It is not panic. Panic is loud. Panic is emotional. Panic is visible. The final phase is quieter. It is resignation. Resignation is not fear. It is acceptance. Acceptance that conditions have changed. Acceptance that previous assumptions no longer hold. Acceptance that effort no longer produces the same outcomes. This shift is subtle. Markets do not collapse when panic peaks. They collapse when belief fades. Belief in recovery, belief in intervention, belief in control. When belief erodes, behavior changes fundamentally. Participants stop reacting to news. They stop chasing rebounds. They stop trusting narratives, not because they are scared, but because they are tired. This is the most dangerous phase of the cycle, because systems built on participation require engagement. When engagement fades, liquidity disappears. Not suddenly, gradually. Volumes decline, depth thins, participation narrows. Markets still move, but fewer actors are involved. This reduces resilience dramatically. In earlier phases, volatility is driven by positioning. In later phases, it is driven by absence. Absence of buyers, absence of conviction, absence of willingness to absorb risk. This is why late cycle breakdowns often feel hollow. Moves are sharp but unconvincing. Rebounds are shallow but exhausting. Ranges widen, but participation declines. The market becomes brittle. Another defining feature of resignation is indifference. Bad news no longer shocks. Good news no longer excites. Prices drift lower, not because of selling pressure, but because buying pressure evaporates. This is structurally different from panic. In panic, everyone wants to exit. In resignation, no one wants to enter. Liquidity does not vanish because of fear. It vanishes because of disinterest. This distinction matters because interventions are designed to address panic. They inject liquidity. They reassure confidence. They restore trust. But resignation does not respond to reassurance. It responds to incentives. And late in the cycle, incentives are weak. Risk-adjusted returns deteriorate. Volatility rises. Drawdowns persist. Participation becomes unattractive. Another hallmark of resignation is reduced narrative power. Stories stop working. Explanations fail to inspire. Forecasts fail to motivate. Optimism feels forced. Participants stop listening. This is when markets become directionless but unstable. Small flows cause large moves. Technical levels lose meaning. Volatility becomes erratic. Another characteristic is capital rotation into safety without urgency, not flight, migration. Cash balances rise slowly. Duration shortens. Exposure reduces incrementally. This is not dramatic. It is persistent, and persistence drains liquidity. Another defining feature is the breakdown of reflexivity. Earlier in the cycle, price increases reinforce confidence. Confidence reinforces buying. Buying reinforces price. Late in the cycle, this loop breaks. Price increases do not restore confidence. Confidence does not return. Buying does not follow. Rebounds fail. This is when markets stop trending and start decaying. Another element of resignation is the decline of leverage tolerance, not forced deleveraging, voluntary restraint. Participants reduce leverage because it no longer compensates risk. This reduces amplification, but it also reduces liquidity. Markets become thinner. Another factor is the shift in time horizon. Participants stop thinking in terms of weeks or months. They think in terms of survival. Preservation replaces optimization. This is not bearishness, it is pragmatism. Another sign of resignation is the collapse of optionality. Strategies that relied on flexibility fail. Convex trades disappoint. Hedging becomes expensive. The system loses elasticity. Another characteristic is that correlations remain elevated even without stress. Assets move together not because of fear, but because flows are shallow. Diversification stops working quietly. Another hallmark is policy fatigue. Interventions lose impact. Announcements produce brief reactions. Then indifference. Markets stop responding because they have already internalized limits. Another defining feature is asymmetry exhaustion. Upside becomes increasingly capped. Downside remains open-ended. Participants notice. Risk appetite declines. Another element is that participation becomes concentrated among short-term actors. Long-term investors step back. Liquidity becomes transient. Volatility becomes jumpy. Markets behave erratically without clear trend. Another sign of resignation is that drawdowns feel repetitive rather than shocking. Each decline looks familiar. Each rebound feels weaker. Participants stop reacting emotionally. They disengage. Another feature is the erosion of benchmark relevance. Beating benchmarks no longer matters. Avoiding losses matters. This shifts capital allocation behavior. Another characteristic is the rise of inactivity. Cash sits idle. Capital waits. Waiting reduces liquidity. Another defining aspect is that markets stop rewarding optimism. Optimistic positioning underperforms. Defensive positioning stabilizes. This reinforces disengagement. Another element is that narrative leadership disappears. No single theme dominates. No sector leads convincingly. Markets fragment. Another sign of resignation is that volatility spikes feel random. They lack narrative justification. They resolve quickly but recur frequently. This is structural instability. Another factor is the disappearance of marginal buyers. Marginal demand sets price. When marginal buyers disappear, prices drift lower. This drift accelerates during stress. Another defining feature is that risk premiums widen slowly, not explosively. This is dangerous because it invites complacency. Another element is the normalization of drawdowns. Losses become expected. They lose emotional impact. This changes behavior. Participants stop defending positions aggressively. They let them go. Another characteristic is that liquidity provision becomes opportunistic. Market makers provide liquidity only when compensated heavily. Spreads widen structurally. Another sign of resignation is that news flow loses relevance. Markets stop reacting proportionally. This disconnect confuses observers, but it is logical. Structure dominates narrative. Another element is the decline of confidence in forecasting. Participants stop believing projections. They focus on present conditions. This shortens horizons further. Another hallmark is the erosion of trust. Trust between counterparties. Trust in liquidity. Trust in continuity. This does not cause panic. It causes caution. Caution reduces flow. Another defining feature is the increase in idle capital. Idle capital is not stabilizing. It is inert. Inert systems are fragile. Another sign is that risk management becomes dominant. Opportunistic behavior declines. Defensive behavior increases. This shifts market character. Another element is a slow recognition that the cycle is ended. Not announced, not dramatic, accepted. Acceptance is the final stage, and acceptance is dangerous because acceptance removes urgency. Without urgency, adjustment drags. Dragged adjustment erodes capacity. Eventually, an external event forces resolution, not because it is large, but because the system is thin. This is when breakdown becomes visible, not at the peak of fear, but at the trough of engagement. The final phase of a market cycle is not chaos. It is exhaustion, exhaustion of belief, exhaustion of participation, exhaustion of capacity. Markets do not fail because participants panic. They fail because participants stop caring. This is the quiet ending. No drama, no headlines, no single trigger, just declining resilience. When resilience disappears, even small shocks matter. This is why late cycle collapses often appear sudden. They are not. They are the consequence of prolonged disengagement. Understanding this reframes risk. The most dangerous markets are not those filled with fear. They are those filled with apathy. Apathy removes buyers. Apathy removes liquidity. Apathy removes support. And when support disappears, structure asserts itself. Markets do not collapse loudly. They decay quietly until they cannot.